Hello, welcome. This is the Short Vol Show live, and my name is David Bechtold, David Lincoln Bechtold, broadcasting to you from Cape Cod, Massachusetts, home of the Pilgrims. And let me try to get my headphones out of the way there. And we are having a good day with the position here, folks. You can see the P&L behind me. Added about $520 to the P&L today so far, which was cool. How did we accomplish that? Well, kind of had a risk-on position in UVXY. So if we look at the chart here, and I'm going to get in a minute to what's going on in the market, what's going on with the VIX term structure, what we should do moving forward with volatility. But for the moment now, I'm just going to go over the latest to the position that I've been broadcasting publicly here. And it looks like my screen is moving slowly again, but a little bit faster than yesterday, fortunately. So I did switch. I had a position where I was long like some November put spreads, which was giving me a delta of short like 140. But I decided to go to a more risk-on type situation yesterday afternoon because, well, basically we'd been short all these deltas going on the way up in this thing, and so I figured I needed to be short a similar amount of deltas on the way down. So I did roll the position, and right now I'm currently attempting to pull up my trade history from a couple days ago, and I think it will let me do that. But if we just pull this trade history to 2 days back, because I want you to be able to believe what I tell you, and I want to be very transparent so you can actually see the trades taking place, because this is one of these situations where the position did make money, and I don't want people to be able to say, oh, well, you're one of these guys who, like, after the fact, tells us that, like, oh, I knew that would happen, and meanwhile, it's 24 hours later. There's tons of people online who can predict the past very well, and who will tell you what happened in the past. And we don't really need that. That's not really necessary. All right, so let's see if that does the trick. Here we go. And this is like way too much information now. But let's go to the trade date of yesterday. And you can see, here we go, 8/23, 24. 29. Okay, so down here on the bottom, if I get out of the way for a second, and if you really want, you can screenshot this to prove it. But I rolled out of the, where is it right here? Basically, I got out of I had this no spread on, I got out of it, and I bought, what did I buy? I bought what I have on right now, which is a out of the money, or in the money put spread, which expires in like 8 days. So this is a risky trade in that if all of a sudden we spike, there's not much time for this to come back. There's only 8 days left. And what do I own? I own the 37.5, 34.5 put spread. So UVXY here, we're down by 31. But essentially, when I bought this put spread. There's $3 between the strikes, between the 37.50 strike and the 34.50 strike. So what is the most a put spread can be worth that has $3 between the strikes? That's a question for you folks. Okay. Anyone? Bueller? Anyone? Voodoo economics. No, the answer is $3. If there's $3 between the strikes, then the put spread's worth $3 maximum. So what did we pay for this put spread? We paid $2.02. So if you pay $2 for a spread that can be worth up to $3, then how much more can you make if you leave the spread to expiration and UVXY closes 34.50 or below? Anyone, Bueller, anyone? The answer is $1. So we paid $2 for a potential. We paid $2 for a spread that has $3 between the strikes. We're looking to make that final dollar. So you're risking $2 to make $1. What are we doing synthetically to the call spread? Well, buying this 37.5, 34.5 put spread for $2 is the same as doing what to the 34.5, 37.5 call spread? Bueller, anyone out there? The answer is we pay $2 for the put spread. There's $3 between the strikes. So what are we doing to the call spread? We are selling the call spread for $1, right? So when you buy a put spread for $2 and there's $3 between the strikes, you're synthetically selling the call spread on the other side for $1. So what is the call spread worth now? Well, we can cue it into our screen and take a look. So if I were to buy the 34.5 call, and we're waiting for the machine to respond. There we go. And then if I were to hold control and click on the bid for the 37.5 call. So now if we were to buy this call spread, we could pay 48 cents for it. So we synthetically sold the call spread for $1. Well, we paid $2.02. So we synthetically sold the call spread for 98 cents. Plus commission is $1 on each side. So if you add commissions in, we synthetically sold the call spread for 96 cents. Okay, we bought the put spread for $2.02. If you take the distance between the strikes, which is $3, and you subtract the premium for the put spread, so you take $3, you subtract $2.02, which is what we pay for the put spread, you get 98 cents. The commission for putting the spread on is $1, but there's two sides of the spread. There's the buy side and the sell side, so it becomes $2 for each spread. So if we subtract commissions, we essentially synthetically sold this call spread for 96 cents. Are you following me so far? Okay, good. So if we buy back this call, so we can go ahead and we could buy the call spread here, and as long as we're paying less than 96 cents, plus, again, commissions, right? Another 2 cents to take the spread off. So if we're paying less than 94 cents, then we'll be profitable in this trade. Well, right now, the midpoint for the call spread is 48 cents. So we can buy this. If we pay 48 cents for this call spread, how much money did we make each time? Anyone? Okay, so the answer is 96 cents minus, 48 minus 2 for commission. So 96 minus 42 is 54. So we made $54 if we were to buy this paying 48. Now it's only offered at 50. If we were to buy it paying 48, which is the midpoint, we don't know if we can get it there, then we would make $54 each time we put this trade on, right? So we paid $202. We paid $202 for the initial spread, so $202 each time we did the spread. And for that $202, the next day, we can take the trade off and make $54 each time. So that's a great return, right? Now, here's a little bit more advanced question for you. Okay, so I sell the put spread. I bought the put spread for paying $202. We know what we're synthetically doing with the call spread, but which would we rather do against this trade? Would we rather just sell that put spread back out for a higher price? Or would we rather buy the call spread? So we're synthetically doing the same thing, whether we sell this 37.5, 34.5 put spread. I almost wish I'd just done the 37.34 spread so I didn't have to keep saying it over and over again, the half part. But if I bought the 37.5, 34.5 put spread paying $202, now I want to exit the trade. Which is a better thing to do? Sell the put spread out or buy the call spread back? Well, it depends on price, right? Which one could we get for a better price? And to determine that, we could, for one thing, look at the open interest here. It looks like the calls have more open interest, so there might be more liquidity in the calls. We might be able to get filled mid-market better. Now, if we are to actually just look at the prices that the computer is giving us, let's look at trying to sell this put spread out. Okay, so if I sell the 37.5 put for 670, and then I'm going to click on the offer, hold control. So it has this midpoint being 252, which is exactly the same price as buying the call spread for 48 cents. So basically, according to this, if we were able to trade at the midpoint, these are basically exactly the same. Now, and this is the advanced part here, why would we, if they're both exactly the same price, we would prefer to just sell the put spread out than to buy the call spread against it. And you know why that is? Well, the answer is pin risk, okay? Yes, you can buy this call spread back in. And the other answer, I think, is maybe buying power. Maybe it's not going to notice. I don't think the buying power is going to consider you having taken the position off completely if you buy the call spread. Although we know that if we did buy the call spread in, we have taken our risk off, because all we have in the end, if we buy that call spread in, is we've got a long call short put on the 34.5 strike and a short call long put on the 37.5 strike. So we've got long synthetic stock on the 34 strike and short synthetic stock on the 37 strike. But the other reason we would rather just sell the put spread out than buy the call spread against it is pin risk. Now, what's pin risk? Pin risk is risk on expiration. If for some reason on expiration, these things expire right at the 34.5 strike or the 37.5 strike, then we have a problem, because if this expires at either one of those strikes, we are going to be short one of these options. It's either going to be a call or a put. If it expires at the 34.5 strike, it's going to be a put we're short. If it expires at the 37.5 strike, it's going to be a call we're short. And you don't want to be short an option right at strike on expiration, because you've taken the power out of your own hands. You don't know what the person who's on the other side of that option is going to do. You don't know if they're going to exercise that option or not. So to avoid pin risk, if we can all help it, we'd rather just sell the put spread out for a profit. Even though we know that synthetically buying the call spread is exactly the same thing, because we don't have to worry about pin risk, and I don't know if buying power is going to be, if the margin requirements are going to accept the fact that you've taken your risk off if you buy this call spread in versus the put spread. We could take a look. Let's just queue it up and see if it shows this reducing buying power or increasing buying power if we put this on. Okay, so it shows us losing buying power. So it's not taking this as canceling out the rest of our position when we actually buy the call spread against it. Anyway, that's a tangent. Let's get back to the main position here. Okay, and as we speak, UVXY has been actually moving lower still, which is good. And then people have asked me in the last couple of days, they said, all right, what about the bullseye position? Well, let me send that out to you, and I'm going to switch screens, and I'm going to ask you, why have we not switched to selling naked calls in this situation? And I'll give you a hint. This is a think or swim trading account. Let me pull up the dashboard to see if I can actually look at people's answers. Anyone? Okay, the answer is we cannot sell naked calls in a think or swim account unless we have at least $5,000 in our account. So because our P&L dropped below $5,000, we do not have the ability in this account to sell naked calls. Now, we could switch this money over to think or swim or something like that, but at the moment, we don't have money. Now, we could put another $500 in just so we get to that threshold, but I would prefer in this situation if we just not add or subtract any money from this account. If we just leave it, and we'll see if we can build it up from here. Now, it might just go to zero and the experiment's over, but we'll hope that that doesn't happen, and we will build it from here. That's another point I want to make, by the way, is I was taught by a risk manager not to use the word hope, take it out of my vocabulary, and never use it again. I want to congratulate Don Kaufman from Theo Trade, because his most recent video, he did mention, wow, everybody in the world seems to think the market's going down, so we're probably going to get a rally soon. And he was perfectly right on that. I congratulate him. So yeah, this was a great move for the position, because instead of the position I had on before where I was only short like 140 deltas. This had us short like 300 deltas overnight, and so we were able to catch a nice move down. Now the question is, what do we do moving forward? We can hold on to this position. So right now this put spread is worth basically $2.50. So if we hang out, we can sweat it out for another 8 days, and if UVXY is below 34.50 in 8 days, this put spread will go to the full $3, and we will collect an additional, essentially 50 cents times 16. So what's 50 cents times 16? It's about $930, something like that. Hold on. 50 cents times, sorry, I'm a little rusty. 50 cents, $800. So that should have been obvious. See, I told you I was rusty. So we can either leave this position on and we'll collect another $800 if UVXY is still below 34.50 in 8 days, or we could take it off. We could take a little bit of it off. We could do a lot of things. We could spread this into a less risky spread. I think that would be a good idea. Spread this into a spread that is farther out in time so that we don't have to worry about this blowing up in our face at some time right before expiration. I mean, we're going into a holiday weekend here, and we don't want this to blow up in our face right during the holiday weekend. So we could take this off. Right now, we have 16 spreads on. Our delta is showing short 180. And, since I publish when I lose money, I'm fine with publishing and making money on this because I want to be honest with you guys. I'm not the kind of trader, of course, that's just going to come in every day and say, I made $34,000 today. And you guys, if you buy my class and each spend $500 a month, you can do it too. Come into the chat room. It's not the point. The point is to teach you how to execute and think about stuff. Let's back up a little bit and let's talk about volatility and what's happened today. So as far as I can tell, the reason we're rallying is reduced trade tensions with China. Seems like part of it. It says, Drudge Report says, Comey roasted, Barr doesn't prosecute. So let's see. Former FBI Director James Comey violated FBI policies in the handling of memos. The watchdog office said Comey broke Bureau rules by giving one memo containing unclassified information to a friend. All right, so that's obviously not why the market's moved up. The Justice Department has decided not to prosecute James Comey. Oh, that must be why the market rallied. Okay, so the market rallied because there was more buyers than sellers. Trump confronted by Fox host over criticism of network. You're using an ad blocker. Anyway, so let's take a look at the term structure now. VIX now below 18, all the way down to 1778. That was fast. When it breaks, we couldn't get it to break yesterday below 20. It was like pulling teeth. The market was up. It wasn't up as much as it is today, but it was up like 5-6 points, and we couldn't get this thing to break for so long. But now all of a sudden, look at the term structure, looking much better. Coming back to normal almost, I would say. Contango now 3.54%. And, the back months hanging up a little higher than maybe they have been. If we hadn't had these extended moves, I would think that these back months would be lower now. But back months hanging up, and they may hang higher for a while longer, which is actually good because, as I said before, we want the back months as high as possible. That way, when the new month comes out, we can be in steeper contango. But everything kind of coming back to normal now with the term structure, and this speaks to the fact that we're back in a normal a more average type vol range than we were before. If we take a look at the VIX chart here, we can see this as that's the most recent mini spike, but let's back it up a little bit more here. So there is 10 days. That's not going to give us enough time. Let's go to like 30 days here. All right, so here's 30 days. So that still doesn't give us enough time. Let's go to like 60 days. Will it give us 60 days? How about 90 days? There we go. All right, so here's the most, that's not 90 days. Hold on one second here, folks. 90 days, but we don't want 30 minutes. All right, here we go. So you can see the most recent spike in August. Boom, right? Comes down, revisits, but it seems like we're in a descending triangle here. You see that? I could draw a triangle on there, descending. And this is all like we're reverting from that initial spike, it looks like. Now, can this have another leg up? Certainly can. I can't tell the future. But coming down off of here. And I hope I wasn't too insulting towards somebody on Stock Twits this morning. This guy was writing, oh, a UVXY bouncing off key support. No, not Grim Contango. Grim Contango is my buddy. Nice to see you there. But another person, and I'm not trying to be a jerk when I say this to people. I'm just trying to like teach people, and I guess some people say this is an opinion thing. I don't think it's an opinion thing, but somebody came on and was saying like UVXY. Here we go. Jimmy Javelin, and I'm sure he's like, I'm not trying to be a jerk here. Here, we'll just follow him. How about that? All right. This is what it says. UVXY. If you have SPY/triple Q calls, I'd sell them as soon as possible at the open. UVXY bouncing off key support. Look at volatility to pick up, aka SPY will be lower this AM. Now, what's wrong with this to me? Well, key support, this chart is like a stock technical analysis chart, okay? UVXY is based on two futures, and the futures are, the percentage of the futures is changing all the time. So you've got a lot more like mechanical stuff moving around than you do like a supply and demand chart. So, for example, back here in July, the things that made the underlying in July of this don't even exist anymore. That was the July and the August future. Those don't even exist. They aren't even in the calculation anymore. So this chart does not account for the variables of contango, backwardation, delta, beta drift, nor does it account for the fact that UVXY is driven by, notionally speaking, by trade in the SPX options. That's what moves this. It's not moved by people looking and saying, oh, there's a support line here. I'm going to start buying UVXY. I'm going to defend that level of support. Now, if you have a stock, you could have a situation where like everybody's kind of on the same page and Apple gets to, I don't know, just use an example. Apple gets to 200. It's bounced off there a bunch of times. Everybody's like, all right, I'm going to buy it 200, and it becomes a self-fulfilling prophecy. In this situation, just because this is a line on UVXY doesn't mean that it's a line in the SPX or anywhere else, because in essence, if you wanted to have an accurate chart to read, you'd have to turn the chart kind of sideways to account it for contango. So if you wanted to take this whole chart and adjust it like 20 degrees sideways so that it was no longer to account for the fact that this is constantly sloping lower, then maybe it might have some meaning. But to have a flat chart that does not account for contango backwardation and say there's key support, it's just gobbledygook. It sounds important, like, oh, it's not just support, but key support. And not to insult this person in any way, I see them applying this analysis to other issues, and I understand that they got these ideas, and it looks like these are Fibonacci lines, maybe this 50 and then 61.8. these might be like different support. I don't know a whole lot about technical analysis, but it doesn't apply here, folks. And so if you're using this stuff, you know, you might as well just say, oh, it went down, so I'm going to buy some because it's lower than it was yesterday, because that's the level of analysis that you're really applying to it. All this key support stuff. And, you know, we can, with the advantage of hindsight, we can also say that this person's dead wrong. I mean, it didn't bounce off anything. It went right through 3206 or whatever, and it's now lower. So not only, so this is not useful to help us to determine how to trade this thing, technical analysis. Now, you can disagree with me, that's fine, but I just think it's a bunch of gobbledygook. And when I see people post like this, I'm like, I don't think you understand what you're talking about. Anyways. Couldn't you bullseye the same spread until it makes money? Yeah, you could put a, you could sell a call spread instead of selling a naked call, but the problem with that is that part of the edge of having the naked call on is just that you're collecting the whole premium. You're not having to pay some premium to buy that extra out of the money call. But yeah, in the place of selling a naked call, you could just sell the call spread, certainly. And maybe that's what we should do. In essence, we have a bullseye call spread on right now, right? Because we've synthetically got the 34 spread on right now. Now, at the money right now is obviously not 34. It's going to be like 31.5 or 31. But essentially, we are short synthetically the 34.5 call. This call that's worth $1 here. However, we're short the spread, so it's only worth 50 cents to us instead of $1. But yeah, I mean, that's essentially what we have on right now. So we could leave this long put spread, aka bullseye short call spread, on until right before expiration, and then roll it out, and we would be essentially bullseyeing it. So I still haven't figured out if we want to roll this out, do something different with it. We did add money to the account like a week ago. That's why it's showing all of a sudden $500 in buying power that wasn't there. And so we have $500 more dollars in buying power to work with. So we could look at some different spreads and see what we'd like to do with it. But right now, I feel like we're back on track with UVXY. I don't have an urge to like really buy volatility now that it's moved lower. Now, certainly if things play out the way they have been, we're going to get, and certainly over time, we're going to get another volatility spike. We just don't know when it's going to happen. But between now and then, this thing could go way lower or it could go way higher. We just don't know. But I am inclined to do something to this position because it is such a short duration position. I want to move my time till expiration out, but I certainly don't want to get long volatility, and I don't want to chop myself up too much here. I feel like it's a decent bet that this will be below 34.50 in a week, but there's no way to really tell. I know that it's a better bet that this will be below 34.50 in 2 months, certainly, because then you've got the action of contango working in your favor. Let's just do the math really quickly on contango for, okay, and this is just kind of like a side of the page math type thing here, but we're showing 3.5% contango, right? So if, and UVXY is 31, let's call it 30 right now. Oh, 31. So 31 times 0.035 is 1.1 essentially. So this, with this, if contango stays here, if this was just one-to-one leverage, this would move down this is decaying by about $1 a month. Now that just gives you like, it just gives you more information in your mind. Okay, well, I know that this is decaying slightly over $1 a month if contango stays in this area, and I think it's reasonable to calculate contango at 3%. I think it averages more than that over time. Now, 3% is the biggest contango we've been in a couple weeks, probably, but I think it generally averages that over time. We're going to have to see if we come off of this spike or if we keep chopping around. Because remember back in October, we were chopping around for a while, right? So if we go back to October, look at this chopping around in October. I mean, that's big chops, too. Look, up to spikes to 60, back to 45, spikes to 65, back to 45. Back to 65, back on down to 40 something, then boom, up to 94. So this is chopping around and then a big boom. What if we get that again? What if we're chopping around here and then we get a big boom up from here to like 50 or 60? That could potentially happen. It's something we want to talk about. We want to have in our mind every single possible thing that could happen and think about them ahead of time. So then when it happens, you'll be like, oh, okay, well, we already thought about that. This is what we're going to do if that happens. And we need to collect another basically $400 in here. And let's put it this way. If we can collect another $400 in here, then we can move on and return to that bullseye trade where we're just selling a call every week. And I kind of like to do that because I want to show how that works over time to people. So we'll have to wait and see if we're able to accumulate another $400. All right, so that's where we are right at this moment. Coming into a holiday weekend, folks, we'll have to see what happens. Now our triple Q is up to 61, so too bad I didn't hold on. I knew that I had a pretty good feeling that that was going to happen again, but I did end up scratching out of my triple Qs a couple days ago. I like to keep it simple and just stick to one or two things that I feel good about. You don't have to be an expert in everything. You don't have to be trading gold, bonds, and hogs and soy meal and soy oil and everything to make money. You just have to specialize in one little thing and get one little thing that you're good at, and you can be successful in the trading world. Oh, by the way, the thumbnail for today's video is Ed Gein's house in Plainsville, Wisconsin. Ed Gein being the serial killer who inspired such people as Hannibal Lecter and Silence of the Lambs, Leatherface, Psycho. He was one of the most disturbed people. And I think it was in the 50s, everybody was out doing, it was like hunting season had just begun in Wisconsin, and he had been at this Warden's hardware store marketplace, and he had been there the day before, and somebody came back to Warden's, and a relative of the lady who owned the place was a police officer, and she wasn't there, but there was blood on the ground, and they knew that Ed Gein had been there the day before, so they went to Ed Gein's house, and they went in the back, and instead of a deer carcass hanging upside down and already like butchered, there was the lady from Warden's store there. But they found Ed Gein was going out to the cemetery in Plainsville and digging up bodies and taking apart the skeletons and dead bodies and making stuff in his house. So very disturbed serial killer. So that's where that comes from. I don't know why I have a fascination with serial killers, but I just do. Anyway, so that's where we are. Appreciate everybody watching. Position's doing well. I feel like, the short vol trade is alive and well. I'm happy that we hung out with this. It wasn't very fun with UVXY revisiting up to 36 again, but, you just have to hang with the position sometimes, and it will come back. And in this case, it did come back for us, which is great. It's great to have an up day. I was getting a little bit disheartened because I started this series and I put these positions on and it just starts losing money. And it's like, wow, Dave came on and showed us how to lose money in the stock market. That's really fascinating. But things are turned around and we'll see where we go from here. It's just kind of like a Murphy's Law thing that if you start a series, hey, what's up, Bri? If you start a series, that it's going to go against you immediately. But we just have to stick with it. you can't panic. We know how much we had to lose here, and things came back for us, which is great. I kind of went risk on last night. I think we're going to switch to a more risk off situation now that worked out, and we'll feel much more comfortable if we put some distance between us and expiration for the position. So we'll probably roll this out to a little bit more of a risk off spot coming up. I appreciate everyone's support, and I will see you in the next one. If you missed part of this broadcast, it takes about 45 minutes for it to process and upload, and then it's available immediately after that for you to watch through again if you want to. So there we have it. Back in Contango. Big rally in the market today. E-minis up 37. Now the question is going to become again, of course, can we really break to the upside and out of this box? I do encourage you to watch Theo Trade videos. I'm fascinated by those videos every day. I feel like I really don't feel like I'm competing with anybody because there's not that much stock market content out there, and you can gain something from each of our perspectives, both Don Kaufman and I. And you can tell in a way that we're both on the same page, even though we kind of look at things differently at times. He generally being a little bit more bearish than I am, but he did make the call today that he thought we would definitely go up. But the question is like, we have bounced off of this line right here in the E-minis several times, right? Several times. Now, the expected move for this week was 70 points, right? So we started this week, I think, around 2880. So we are about 46 points higher than there right now. So can we get the momentum to get through this area here? Can we break out to 2960? That's a big if. And I really am starting to believe in this stuff. As you know, I just was dissing technical analysis. Certainly I dissed technical analysis for UVXY, but I am a believer here that it's going to take a little something for us to get through this level. Because look, we've bounced off here 1, 2, 3, 4 times so far. We haven't been able to get through this level. So it seems like an important level here. I feel like I should lock in my gains, recent gains, and wait for, what did they say, confirmation? The only thing is like, I'm a little bit concerned about cutting my winners too quickly. You know how they say, like, let your winners ride and cut your losers? Well, I'm a little concerned about that. I think that if we could just stay at this level for a while, it's perfectly possible that we just stay at this level for a while and volatility stays lower. There's no reason for us to really break through. I mean, we're kind of like, we haven't gotten up to that 24 yet again. VIX still elevated, 99 now, but still elevated, but down another 4 points today. I think that's significant. But if we're just bouncing in this box forever or for a longer period of time, people are going to get less nervous after a while about this, and they're going to be kind of like, well, okay, it's going to represent a lower number in the VIX the more times we just stay in this little level. Now, this move today, there is an up move and volatility has come in, but the realized volatility still is there. We still have made a rip today. I mean, this is up over 1% in one day. So this isn't helping the case for realized volatility wanting the VIX to come in. If anything, this is more volatile. It just happens to be to the upside. There's a case to be made for if we had just stayed at 2880 for the next couple weeks, that represents more of a case for vol to come in than us ripping to the upside. However, people, I guess, feel that this is like a relief thing. We've moved up on the skew as far as the XPX is concerned, and that's going to bring vol in, and the VIX is back down. We'll see how long it lasts for. For now, though, happy to be in Contango and happy to be with you and happy to make money. So thanks for watching. Appreciate all your questions. Thank you. Please consider giving like $5 over Patreon if you have the Sean S. Don Kaufman. I say Dan too. It's Don Kaufman on TheoTrade. You could just look up TheoTrade in your YouTube search, and please do check out my interview with Don Kaufman on the channel. I feel like I've done a lot to introduce him to a lot of people, because that is, if you type his name into the YouTube search, you're going to see my interview almost right away. Thanks everybody for watching today. I really appreciate your support and asking questions. Thanks Ed for coming in and asking questions. Thanks Sean for your support. And I see Ed that you were actually putting in the answers to those things. That's awesome too. Sorry I didn't get the chat up quick enough to see that. You guys make it real for me. So thanks a lot. You know, as this channel grows, it's those people that helped me out at the beginning that really made the difference for me. So thank you so much. I will be back on tomorrow. And best of luck to y'all. See ya.